The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and we're going to talk taxes for the next hour. And you should be right. If you haven't filed yet, you might be getting ready to get all of your stuff together. We want to talk about taxes so that you understand them and that you can use them for your best benefit. And of course, if you need any help, you can always go to EG Tax. Go to egtax.com. If you have tax questions, you can go to Ask the Tax Lady. I will be honored to help you out. And I will tell you, I'm flying solo here for a while today. So wanted to talk about last week I was talking about how your tax return is actually computed, tax tables and tax rate schedules and tax brackets, because people really don't understand how you're taxed. So I want to make you smarter so that you will understand that it's something you really should know, because, my gosh, look at how much money is set aside for taxes every year, and it's really important that you know how your taxes are computed. So anyway, I'm Esther Gulius, the Tax Lady from EG Tax. My phone number is 803-0930. 803-0930, star 930 on a cell phone. You can text us at 716-803-0930. And I want to talk about itemizing. A lot of people think, oh, the standard deduction is so high, I can't itemize. Well, I want to teach you about when you would itemize, how you would itemize, what's deductible in itemizing, so that I can make you a smart person. Anyway, I'm Esther Gulius, the Tax Lady, 803-0930, 803-0930, star 930 on a cell phone. All right, it all starts for people that want to itemize, the reason you itemize is because it would save you money. The standard deduction, if you're married filing a joint return, is $29,200. In other words, you take that $29,200 if you're a married couple, and you subtract that from your income that you have on the tax return. If you can itemize, then your itemized deductions would have to exceed the $29,200, and you think, oh, how do I know what I can even itemize? Well, I want to talk about that. Basically, itemized deductions have 5 categories: medical, taxes, interest, charities, and miscellaneous. Those are the 5 topics. If the things you're writing off exceed the standard deduction, then you save money. Now, here's the interesting thing. On New York State, their standard deduction is thousands of dollars less than the federal. And the state of New York allows you to take deductions that the federal government doesn't let you take. So the truth is, many people should itemize on the state of New York, even though they don't itemize on the federal, because they'll save money. And look who just came in, Tiffany Fabian.
Hey, happy
Is your mic on?
Saturday. Ben, you can hear me, right? Yeah.
All right, great. Yeah, happy Saturday. So we're talking about itemizing.
It's very important. I just finished doing that for a couple of folks in my office, and they itemize on the state but not on the federal.
Right. And so the standard deduction on New York State is married filing joint is $16,050. So it's $13,150 less than the federal. So it's easier to itemize on the state. Plus, the state of New York allows you to take business travel, office and home, financial planning, and the federal government doesn't. So the thing is, you could absolutely save hundreds of dollars by itemizing on the state, even though you can't itemize on the federal.
Yep. Do it all the time. Yeah, it's really something that I also was with a guy earlier who does sales for a roofing window company, and so they don't pay him for his miles, so he does lots of travel. he uses his cell phone for work. He takes some clients out to lunch. He
And here's
Lots
the
of
thing.
expenses.
On the federal, that's one thing when Trump did the tax cuts back when he was first president, he eliminated that deductibility on the
Yeah.
federal. Well, the state of New York said, well, we think you ought to be able to take those expenses. So if you're an outside salesperson, you really should go to your boss and get reimbursed on an accountable plan, because on the federal, you just can't take that.
Right.
And you're basically throwing the money out the window.
Yep.
So
Well,
let's
and then even this guy I was with earlier, his employer is going to start this year in 2025 giving him $400 a month, which doesn't equate to what his expenses are.
but is it accountable or unaccountable? If it's flat, it's going to be taxable.
correct, right? I talked to him
And so
about
that's
that.
what's so important. We
Right.
want to make sure that we get you smart.
Mm-hmm.
All right, so let's talk about medical deductions. First of all, the medical threshold is 7.5%. So in other words, till you get your medical exceeds 7.5% of your adjusted gross income, there's no deduction,
Right.
because they reduce it by that. But there's all kinds of things that qualify for medical. Acupuncture, air conditioning, a removable air conditioner if you have an allergy, ambulances, artificial limbs, birth control pills, a body scan if they put you in that. Is that
CT or
CT?
MRI?
Yeah. Braille books, breast reconstruction after mastectomy, capital expenses. If you are somebody that maybe has really bad arthritis and you can't get around your house and you have to install one of those little elevators,
Right.
that's
lift.
deductible. Or maybe your bathroom is a danger because you can't get into the tub.
Right.
I feel like one of those commercials on TV. and they do and you get a walk-in shower, and the doctor says it's because of a medical condition. That would be a capital improvement, but it would be deductible,
Right.
partially at least,
Correct.
right?
Spread out over if it increases the value of your house.
Right. So here's the thing you have to do. If you, let's say, to redo your bathroom is $15,000 to make it so that it's safe for your condition, and it increases the value of your home by $5,000, you have a $10,000 medical deduction.
Right.
So,
There's
okay,
a
why don't we go to Harold, who's been waiting? Hi, Harold.
Good afternoon. My question is, I have a brokerage account. I got a 1099 DIV, and it shows exempt interest and dividends. I have one fund in that account, in that brokerage account, that has municipal bonds.
Right.
Okay, on my federal, on 2A, I'm showing that $600 of tax-exempt interest. When I go to New York State on line 21, I think they're asking for that.
Okay, all of your income from the federal is going to carry forward 100% to page 1 of the IT 201, okay? But then there's an addition and a subtraction section.
Exactly. That's where the
When you're
the
carrying
line
forward
21
that
is in
figure from the
additions.
federal, there is no taxability. So you're not. It's not even going to end up on the New York return, because if it's truly tax exempt income from New York, there's nothing you have to do. However, if it's tax exempt income, tax-free income from Arizona, you have to add back in what isn't included on the federal return under additions.
Okay. Now I looked up in the computer. This fund has 14% of their assets in New York State. Would I take 14% of the $603 and then subtract that from the 603?
No,
From the
okay. It's just the opposite. It's already tax-free on the federal. So what you're going to do is only 14% is tax exempt on New York State. So you're going to add back in as income the remaining of the 100%.
Okay. Okay.
So
On the
14%
addition line.
is tax-free. So you're not going to add it in. It's not in there to begin with.
You're going to put it on the addition line.
Right.
On page 2 of the IT 201.
Okay, so I won't be on that line 21 on the New York State. I won't put the whole $603. Only
No,
a
you're going to
portion
put
of it.
82% of it.
Okay, that's
Okay.
what I that's what I thought. Now my second
All right.
question.
Thank you.
Second
I
question.
have one other-
All right.
He has a second question.
Okay. Yeah.
Okay, because my wife passed away, I had to sell some securities, some bonds. I had a whole bunch of interest this year, so I did estimated tax.
Okay.
It took care of that. But I overestimated the estimated tax, and I have $1,000 left over. So
Okay.
is it better to take that as a refund or apply it till next year's?
All right. So,
Depends on your
you know,
situation.
you can apply it to next year. But I will tell you from an accounting standpoint, many times people forget about it. So sometimes just for clarity, I have them get the money back, you know, as a refund on this year, and then just start the new estimated payments because it's very clear there was nothing held over. Now, if you're somebody that's going to make sure you're a good statistician and you're going to keep that $1,000 that you're applying to your estimates, so you don't forget about it next year, that's great. But I just have a gentleman that I'm working with who told his accountant he had made 4 estimated payments and he had an overpayment that he applied. He had, applied it incorrectly. Then the next year, the IRS lost track of the estimates that he had done, and he ended up paying an extra $10,000 that he shouldn't. And I'm working with a tax advocate to get it straightened out. So
So
I'll leave it to you, whatever you think.
There's always a chance that it'll get in the wrong spot.
Well, you got to remember that you put it there, and if the IRS didn't apply it correctly, you know, it ends up being a problem. I'd get it back as a refund.
Okay. Well, thank you very, very much.
All right, you're very welcome. Thanks for calling. I'm Esther Gilius, the tax lady from EG Tax. Esther with a cold. We're going to take a short break. We'll be back with your calls and questions and texts. To us, you are family. I'm Esther Gilius, the tax lady, with Tiffany Fabian. You've been kind of sequestered in all tax season doing taxes.
Right. I really have. I missed being here with you guys, with you. And so, but I've been working
I thought
really
I almost
hard.
missed you today.
Yeah, because I was doing somebody's tax return.
And I said, let's go. We got to go. do
And
the
I
radio show.
did it all married separate because the answer was better, but then they put money into a Roth, and so you can't put money into a Roth if you're married separate.
That's right.
So
That's
I had
one
to
of those penalties.
put it all back together again.
Anyway, I'm Esther Gilius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We have an interesting text right here, Tiff.
Yes, we do. The text says, "Hey, Esther, love you guys. I have a personal boat that I used for 4 months as an office for my LLC. My LLC, which is a sole proprietor, paid me $3,000 for the use. An LLC, can I use the C, an LLC, use it as an expense? Can I write up $3,000 of income with the boat maintenance,
Okay.
etc.?
All right. Here's the deal. You cannot use a boat. First of all, in order for any deduction to be deductible, they have to be ordinary and necessary. That's number one. Number two, to have an office in your home, you know, you have to have a room set aside regularly, exclusively for business. Number three, they don't allow you to take boats as a deduction, except if your boat is a personal, your second home, then you could and you have a mortgage on it, you could take the interest. So, no.
No,
Unless you want to spend time with the IRS agents that the former president hired. I mean, it would really, in my opinion, you would lose, and it would be very costly.
And not to mention, a sole owner LLC is a Schedule C, And so
And you can't even write yourself an expense that way.
Right. And
Right.
so a sole owner LLC is a Schedule C,
Right.
and you don't have income, so you can't do an office and home. And so,
Well, you can do an office and home if it was in his home. And
right.
he had a
but-
room set
but there's
aside
no-
exclusively for
It's not going to
business.
make you more negative, is what I'm saying.
Did he say it was negative?
I can write off the $3,000 income on the boat maintenance. I don't know. It's very confusing.
Well, anyway, the other thing I want to tell people is if you have a sole proprietorship and you have an office in your home, and the bottom line is a loss, you cannot take an office and home. That expense for the office and home is suspended to next year.
Right.
Okay. All right, and we have Peter. Hey, Peter, how are you? I'm Esther Gullius.
I'm fine, Esther. How are you? I'm glad you're well. Let's put it that way.
I'm weller than I was last week, but I'm still sounding like nasally. Well, how can we help you?
Long winter. My daughter sends her son between $700 and $900 a month. He's in college on that Venmo, and he got some kind of statement from them saying
Okay.
that it's income or something. I'm not sure. Does she need to take that to the
All right,
tax
are you
man?
saying she got a 1099K?
I think so. He got that, I think, because he got the money from her
Okay,
through Venmo.
but what's your question?
Does he have to take that to some tax man?
So
I mean, is that-
So yeah, we can allocate for what the money was spent for. What did they use the money for on Venmo? Was it used for purchasing tickets? Was it used for
Used for his personal expenses during the college year.
right?
All right.
So we can allocate
That's it.
that.
We basically include the income on Schedule 1.
Right.
And we exclude it on another schedule. So you have to put it on. I'll tell you the truth. If you don't put it on, you're going to get a letter in the summer.
Right.
And then then now you're in the crosshairs. So you put it in, and then you take it out as a personal expense.
So that has to go to the tax man.
Well, I mean,
Yeah.
you know,
So when she takes
it's
her
gotta
taxes,
be- it's
she
gotta be
takes that with
included.
her. Okay. She wasn't
okay.
sure what
I mean,
the heck was
and
going on about
actually
that.
now starting this year in 2025, they're going to start sending those 1099K forms if you have income from Venmo or any kind of third party over $600. So a lot of people are going to be getting them next year.
So it'd be easier to send a check or something rather than do that Venmo thing in the end.
Might
She's
be.
gonna be
Well, I'm
exposed
going to
next
tell
year.
you that the third party payer is under the crosshairs of the IRS. So a lot of people are making a lot of money, like selling Bills tickets, for instance. You can have a cottage industry reselling tickets. And by the way, if you're on Facebook, I'm not selling anything, but because I got hacked on my Facebook page. But you want to make sure that if you're doing those third party pays, you could end up with a 1099K, and it just ends up to be a pain in the neck.
Oh, okay. I'll let her know, and I'll tell her to
But-
stop doing it.
Yeah, but there's a way to allocate for it.
Right.
But the problem is they're trying to, put
There's-
under
there-
their thumb
there's-
the people that aren't using it.
That's right.
with
There are
yelling-
people
selling
not like
tickets.
you that are doing it to make money, and
Selling
the
bills,
IRS wants
savers.
it. If you made money, they want it. All right, Peter.
Thank you.
Thank you, sir. I'm Esther Gullius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We got Mike Holden here. Hi, Mike. Hello, Mike. No Mike. All right, let's go to John
No
in
mic-
Niagara Falls.
No mic is on the mic.
Mike. Nope. Hey, John.
Hello.
Hello?
Hello. Hey, how you doing?
Good.
Hey, I got a question about me and my wife sell stuff on eBay and a few other sites.
Okay.
And what's the limit that we can sell up to before you got to start claiming.
You mean how much do you have to have in sales before you have to report it?
Right.
All of it.
Okay. All income, unless specifically exempt, is taxable and has to be reported. So whatever she makes, she has to report.
And they won't issue you a 1099 unless it's over 600.
Right. But if you make more than $400, you're going to pay FICA on it. But remember, she has her income and she has her expenses, and it's the bottom line that she pays taxes on.
Well, I do it too, so I was wondering, we got, probably 6 or 7 accounts that we saw online.
Okay.
So we got to claim
well,
all of it,
you sure do.
and then
Well,
of course,
I want to be clear. You put it on the Schedule C, okay? Then you reduce it by the expenses to make the money. You pay taxes on the bottom line after your expenses,
So-
but you first have to put the gross income in.
And don't forget, you can deduct like your cell phone use, a percentage of it, your
Shipping,
internet,
advertising, web
driving to
page.
the post
Yeah,
office.
right. There's all kinds of expenses. Anyway,
Right.
I'm Esther
Whatever you
Golias, the tax lady from EG Tax. We're going to take a short break for the news, and we'll be back on the other side.
From the WBEN Paul Davis Restoration Newsroom, I'm Zach Penque. Here's what's happening. A Niagara Falls woman remains in the ICU after she was struck by a vehicle yesterday evening. Police say the 41-year-old driver was traveling south on Hyde Park Boulevard in the right lane when he struck the 30-year-old victim. She suffered severe head injuries and was transported to ECMC, where she is currently being treated in the trauma ICU. The driver was not injured and is cooperating with officials. An arrest has been made in the double homicide of Mickey Harmon and Jordan Collado this past week. Erie County DA Michael Keene says 34-year-old Brian Chiclano was arraigned and charged on 1 count of murder in the first degree and 2 counts of murder in the second degree.
The allegations are that on Tuesday morning, March 4th, the defendant unlawfully entered into the victim's home on St. Louis Place through a basement window. While in their home, the defendant intentionally struck both victims in their heads with a blunt object. The defendant killed both victims.
From the WBEN Paul Davis Restoration Newsroom, I'm Zach Penque.
Hey, to us, you are family. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Mike is back. Hey, Mike.
Hi, Esther.
Hey,
I have received in the mail something from the IRS. It was 4 envelopes, blank envelopes to the IRS. It said
I know what it is. I know what it is.
1041 ES.
Yep.
Yeah,
A lot
and-
of people, all right, a lot of people, if you are somebody that got estimated tax payments from a trust, for instance, a lot of people from trust, you can throw them in the garbage can. If you don't have an ongoing trust, they sent those things out to people, trusts that were done years ago. So you can, Mike, you can throw it in a garbage can.
Unless you
Oh,
have a
wonderful!
trust.
Because I was going to say this happened 15 years ago when my father passed away, and I said I don't even think I have any of the records.
Right. Well, see, whenever you owe the IRS money, then they require that you prepay that projected liability, and that's why they send you those estimated payments. But the truth is, these are so long gone. Many of these things, most of them, people came in and said, "I don't know why they would be sending me these." You can just throw it away.
Sounds like they got carried
Wonderful.
away.
Right. They got
Thank you
carried
very much.
away, and you can throw it away.
Great.
All right. I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930.
Yeah, and then going back to John, who had the all that income that he received from it was self-employment. It was from selling stuff on eBay, I think. And don't forget also, if you're a self-employed person, you can deduct your health insurance on the Schedule 1, or if you make any payments to your pensions and things like that.
Okay, well, I want to clarify the health insurance. That's health insurance that you pay.
Right.
But if it's already pre-tax paid through your employer, you can't take it.
Correct.
Okay.
Yep.
But they also consider Medicare in that
They
if you're
do.
self-employed.
Yep.
So going back to itemized deductions, and going back to medical, guide dogs, if somebody said to me, I saw a commercial that you can deduct your dog. Look, you can deduct anything if it's ordinary and necessary. So if you were visually impaired and you had a guide dog, what could you write off, Tiff?
The cost of the dog, the food for the dog, the care for the dog,
The vet?
for the dog.
Right.
Yep.
So are dogs deductible? Not usually, but sometimes.
Right.
Right?
Correct.
So from a medical standpoint, long-term care insurance, a
Yeah.
lot of people don't realize that even if you can't itemize on the federal, that's a big credit on New York State.
Yep. And then really importantly is it carries forward, carries forward, carries forward. So until you actually use the long-term care deduction, it stays there. For instance, there was a client that I have been doing his return and he didn't pay any liability to New York State. However, one year he did have a liability and the accountant that he used to go to didn't
Didn't know about his carry
didn't know
forward?
about his care forward. So he came here and he's been here ever since.
Right. And that happens. I mean, your old return many times has stock loss
Little
carry
nuggets,
forwards.
yep.
You want to make sure that you put that on the return the next year.
Yep, I was doing some new clients that were referred to me by Mr. Lucy, and last night I was doing their tax return, and I said, I just want to look at your return to make sure there was no carry forward stock losses, and there weren't any, but I just wanted to make
Oh,
sure.
of course, you want to double check.
Yeah.
Another thing that is a medical expense, and I know people may not think about it, is orthopedic shoes. People have feet problems, and if you have to get special shoes, those are deductible.
Yep.
Other
The
thing
Good Feet store.
at the Good Feet store, right? So you take all of your deductible medical expenses, and that includes Medicaid and Medicare and all, and you add it all together. And if that exceeds 7.5% of your adjusted gross income, you then can write that extra amount off.
Right.
Now, what happens if you have a family member in a nursing home?
You can deduct the cost of the nursing home.
Right, and if they're
which
a
is a
private
large
pay,
cost.
and if they're a private pay patient,
If they're a private pay and it's complete long-term care, I'm sorry, if it's complete nursing home care, then there's a bed tax or an assessment tax that they charge at 6% of the total, and you can take that as a credit on New York State. I think it's the 258.
right?
And so it's money in your hand, and it's shameful because I feel like New York State shouldn't even charge it if you're going to get it all back. So maybe they're wishing and hoping that you don't take the credit.
people don't know.
Yeah.
But you think about that. If you paid $100,000 to a nursing home as a private pay patient, and that's low,
Right.
you have a $6,000 refund coming from New York State.
Right.
And if you don't claim it, they get to keep it.
Yep. Which is not
And
so
so that's
good.
That is called a nursing home credit, IT 258. Mm-hmm. Okay, let's go, Teresa. Hey, Teresa, how can we help you?
I had my tax filed,
Yeah.
and before the examiner started, I showed him this letter that I got from the lawyer. I made out of. I went to an elder lawyer to have a will made out,
Right.
and I'm willing everything to my grandchildren. There's 3 of them in from one family. And he just put the paperwork on the bottom of my file and went on to tell me, what's deductible and so forth. He went working on the forms. So I asked him, what about this form that this letter that I have from the attorney? And he told me that I should make sure that the examiner sees this when I'm filing my tax.
Okay.
So he went to another person, and because he didn't know anything about this. So he went to another person, and that fellow said to me, I don't know what your lawyer's talking about. He says, you have to call your lawyer. So I did. The lawyer told me he should get the Form 709 and file the U.S. gift tax return.
Right.
And he said
All right,
to me,
so do you want me to explain what that all is, Teresa?
yes, please.
Okay. When you give more than $18,000 to any human being in a calendar year, then the excess over $18,000 means that you have to do a gift tax return. Obviously, when you gave your home to your heirs by transferring the title, the value of your home that you were giving them far exceeded $18,000 per person. And so the attorney was thinking that your accountant should do a gift tax return, and you should.
Well, the
So did you gift
examiner
it to them, or did you put it in your will that they're going to get it upon your
Right, I got
passing?
it in my will.
Well, then it's not
wouldn't-
a
I
gift
know.
tax. See,
I
if
know,
your
I-
attorney said that you have to do a gift tax return, then maybe you think it's in your will. If you want, Teresa, what part of Cheektowaga do you live?
South Cheektowaga, near Transit Road.
We got an office in Depew over there.
yep.
We got an office over by the Walden Galleria by the McDonald's there on Union Road. Why don't you bring that paperwork into my office at EG Tax, and we'll look at it for you.
Jack Brunwich is there.
Yeah.
Jack is a
And
genius.
Jack's a former IRS agent, so
Okay,
we'll,
now
we'll
can
help you
I-
with that. Okay.
Yes, and I would like to talk to you after you're off the air.
Okay. I'll call you back.
All right. Do you want my number?
You have to give
You have
to the screener.
Right.
Can
Okay.
he put you on hold and he'll get your phone number? Okay, Teresa.
Yes.
Okay, sweetie.
Thank you.
All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone.
Maybe she wants to leave you a house.
I don't want another house. Anyway, that it sounds to me like her attorney was saying that you have to do a gift tax return. So she might think it's in the will. Maybe she did a life estate.
Right.
That's a possibility too. And I will tell you, if he did just change the title and put her children on his
Right.
On the title, that wasn't the best thing to do.
No.
It should have been a life estate.
Right.
That would be better.
So he would have done her a disservice.
Right. So getting back to itemizing again. So then when you take a look at all of your medical, you reduce it by 7.5%. Then you move on to taxes. State and local taxes that you pay, that's an itemized deduction. So if you're paying New York State taxes, whether it's through your employer or whether you owed it last year when you filed your return, that goes on under taxes. Sales taxes, if it's more than your state and local income taxes, then you would use sales taxes over state and local income
Yeah,
taxes.
and a lot of people who are retired don't pay a lot of state and local income taxes, so sales tax becomes much more figurative for retired people.
Well, and I will tell you the other day, and then of course, the problem, of course, is under taxes, the state and local tax limit is $10,000. So you might have paid $40,000 in taxes that are deductible, but unfortunately, the federal government has a cap at $10,000. But that's one of the things Trump wants to change.
Thank goodness.
So that would be very
Even
good
though he was
for
the
New
one-
Yorkers.
Even though he was the one who brought it into.
He was the one that did it. That's
Yep,
true.
yep.
All right. Then property taxes are deductible, and it can be property taxes on your primary, secondary home, a vacant lot. That's where that would be deductible. Then the next part might be personal property taxes. Now we don't have it here,
Right.
but if somebody is in South Carolina, they pay personal property
Right.
taxes or foreign taxes.
Yep.
So let's say, for instance, you have a bank account in Canada, and you paid Canada foreign taxes, Canadian taxes. That's either an itemized deduction or a foreign tax credit.
That's right. Yep. Yeah. And so a lot of times the foreign tax credits you'll see on brokerage statements, like their dividends or their sale of stocks, you might see some foreign taxes paid.
And you do a form 1116.
1116. Yep. You do the simplified method and you just put it up on top and you're good to go.
All right. Then we move on to interest. Now, it used to be that if you did a home equity credit line, that was deductible, but that's not the case anymore unless it's tied to the improvement of your home. So it's your primary mortgage, and if you have a secondary mortgage on that primary home, it's got to be for the improvement or the acquisition or addition to that home. So if it's to anything else, it's not deductible. If you have timeshares, Disney timeshares, no dice.
Right.
All right, I'm Esther Gulius, the tax lady, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. I'm going to take a short break. We'll be back with you and your calls after the break. Hey, we think of you as family, and I got to tell you, a lot of my clients will say, I really do feel like family here.
I could cry. There was a client who came in today, and he's going through a really hard time, and he just thanked me up and down, and it was the most beautiful thing, and he just thanked me, and it was the most beautiful, endearing moment. So.
Right, because when you get into somebody's finances, it's a very intimate kind of thing, So we end up loving everybody. Okay, but we also love Dana. Hey, Dana from Hamburg. How can we help you?
Hi. Can you hear me?
Yeah, we can hear you.
Okay. I just didn't want to have feedback because I'm actually in my car. Okay, so I went onto the IRS site just to file a simple form, and I hit my last entry with a tax code, and it had to do with an annuity that my dad had left for me. And it said that particular basic form was unable to process that at this time. So what schedule do I need to do a basic return, but yet I can include the annuity code that it was asking for?
Dana, was your dad over the age of 59 and a half?
Yes, he was 79.
So don't forget to exclude up to $20,000 off the state divided by the beneficiaries. I think you have a pretty complicated return.
Well, I mean, a 1040. Just get a 1040.
But don't forget to exclude off the state.
Right, a 1040 and a 201.
And exclude the software is going to be very tricky to exclude the exclusion off the state.
Right, because it's inherited. The maximum subtraction you can take for any kind of annuity would be $20,000, but it has to be divided by each of the heirs.
If your dad was over the age of 59 and a half when he passed.
But anyway, you can do a 1040 and a 201.
But be careful about the
Okay,
exclusion
yeah, because
on
I was the only heir. So
you're going to get to exclude $20,000.
Oh, so you are the only heir.
Yes, and it was like that $5,000 taxable amount that I had to enter out of the
All right,
total
so
annuity
that'll
that
all
I
be
had
tax-free
gained.
on New York State.
It'll all be tax-free on the state.
Provided you don't have
Okay,
other annuities yourself.
Well, what about the federal, though? I think that's where my snag was the federal.
Well, it's fully taxable in the federal.
And you
Unless
need
it was
Right,
a Roth.
so
1040, a Form 1040 you need.
1040, not the 201.
You're going to do a state return. It's the two.
and
IT 201 is New York State. 1040 is the federal.
And then don't forget on the 201 on page 2 to subtract off the 5,000.
Okay, all right. There's where I was just, because, everything's broken down, and I just hit that snag. So I appreciate that very much. Thank you.
That's
All
okay.
right.
If you have
all right.
questions
Thank you, Dana.
when you're doing your return, you can call me at 632-7886, and I would answer your question.
Fantastic.
I wanted
Thank you.
while we're
You're
we're
welcome.
running out of time here, so I wanted also to mention under interest that reverse mortgages are people are starting to ask about them again. A reverse mortgage is basically tapping into your equity in your home. It's not taxable and not deductible, but in this part of the presentation, I wanted to talk about that. A reverse mortgage is great for the seniors that want to stay in their home, and maybe they have a small mortgage, but they have equity, and it's a way that they can live in their home and get the equity out completely tax-free.
Yep.
We got, what else we got?
There's a text. It says, "Hi guys, I was wondering why we cannot deduct all of the sales tax we pay throughout the year."
Well, you can deduct it on the Schedule A if you're able to itemize. Sales taxes are, you either take your state and local income taxes paid to New York State, or your sales taxes. And I had a couple the other day that bought 2 trailers, a boat, and a snowmobile, and their sales taxes were like $9,000, but the cap is $10,000. So when you put their property taxes in, they
But it
they
might
could,
not
they
be
could,
kept on the state.
right. They could use the deduction on the state, but not on the federal.
Right. So it might not be kept on the state. And you can either add up all of your figures or you can use the chart figure that they give you to use.
Oh, and I meant to say hi to everybody in Florida too that are listening.
Right.
At our Naples office on
Airport
Pulling Road. Right.
Yep.
At WGuff Radio. And let's see. And then the next thing would be charity.
You told me earlier, I can't believe Florida's tossing around the idea of not paying property taxes.
Right. He's thinking of eliminating all property taxes.
That's just crazy. Wow. There must be some money in Florida.
I think there is. All right. And then the next portion would be charity. Don't forget mileage for ministry, mileage for, maybe you're somebody that does Meals on Wheels. That all adds up. Church, other nonprofits. How about if you do, what's that thing, GoFundMe?
No, it's not deductible because
That's
it has
right.
to be a 501c3. And so that unfortunately doesn't qualify.
And how many times do people say put down whatever the standard amount is for charity?
That's not true. There
I
is no
know.
standard amount.
There is no standard amount. You got to have a receipt for everything. And if you're doing large non-cash donations and they're going to be over $5,000, you have to have an appraisal.
Yep.
All right. Let's go back to the phones. We're going to go to CJ. Hey, CJ, how can we help you?
Yes, Esther, thank you. I heard that Social Security Administration was going to issue a refund to police, fire, and some other civil servants, and it would be a refund for taxes paid through Social Security to the federal return for 2024. I haven't heard any more about it. I want to know if you knew about it.
Okay, so
That's
this
the
is what.
windfall, right?
Pardon me?
The windfall?
Yeah, well, here's the thing. What it is if you were a public servant, like in the railroad or maybe work for the federal government, back in the day when they said you can't collect Social Security because you're in the government system, well, they changed that, and now those people that weren't able to collect because they work for the federal government and they were supposed to get a federal pension, they are now going to get a retroactive payment for the Social Security that they didn't get for last year, the whole year, and they're going to allow them in the system, and it's supposed to be an automatic payment. And actually, I had a client yesterday that had gotten it.
I know I've had some
Yeah.
people get it too. Yeah. Now, were you one of those federal employees who didn't qualify for Social Security in the past?
No, I've been paying federal tax all along. I'm a retired police, and I heard about this. I looked it up on the internet. It was a little confusing. It didn't. It did mention police and firefighters who were retired.
It's people that used to work for the federal government.
Yeah, I don't think you
back
qualify.
20 years ago. Yeah.
Okay,
Yeah,
so
I
it was
think
way back.
I have absolutely never heard of that. I've only heard about the other.
Okay.
Yeah,
okay.
like-
Just wanted to check with
All right,
you.
thank
would
you
know.
for calling. I wanted
Yes.
to.
You're welcome, CJ.
Yeah, wanted to mention here. Give you an example. Let's say that you had charity of 1,000, and let's see, where am I at? Oh, I know. Here I go. So let's say that you had medical of 5,000 and you had taxable income of 7,000. That would exceed the 7.5%, so that wouldn't qualify. If you had state withholding of 3,000, property taxes of 5, mortgage interest of 5, your total itemized deductions would come to 14. The standard deduction is 14.6, so you'd get nothing. But on New York State, because their standard deduction is so low, they would allow you to take like things like business expenses and other things. So in this case, somebody that can't itemize on the federal but can itemize on New York State would save an additional $564.
That's significant.
So, I mean, so don't blow off New York State. I mean, it can really get you some extra money.
Yep.
And like Tiffany was saying about the subtraction for pensions, if you have a federally funded pension or state, actually it's a public pension, on the state of New York, your entire pension, regardless of your age, is tax-free. But once you reach 59 and a half and you have any other pension or IRA and you take the money out, the first $20,000 for each spouse is a subtraction on New York State. And I will tell you, if you do it wrong, they won't tell you.
Correct.
And if you're overpaying, they won't tell you.
Just like if Dana does her return and doesn't subtract the 5,000 for her decedent, they won't let her know. Yeah.
Right. And then the other thing that people need to know is you could have a tax liability based upon your income without itemizing, and you find out that this is your total tax, and you have 4 kids. Well, that will eliminate $8,000, $2,000 a kid if they're under the age of 17, $8,000 in income taxes. So somebody that might have had a liability of $7,307, then they get to the part where their kids are, they end up with the refund that they didn't pay in. So there is, doing taxes is a lot like playing
Russian,
a professional pool. I mean, you got bumper shots and you got corner wedges, and I mean, you got to think out the whole thing and figure out what's the best for you.
Correct.
And you can manipulate it. Like this morning, I had this couple from, where is the war in Europe?
Ukraine?
In Ukraine. They said, I got all done. They owed $2,300. And then she said, should we do the IRA like we did last year? And I said, you want to do it? And she says, yes, put down $4,000. I said, no, that's not going to do anything. So I said, we want to do the whole 16? She says, okay. She ended up with a refund.
Oh,
I mean,
right.
I said, look at you. You're like a true American. You know how to tax plan.
That's true.
Anyway, if you are somebody that is between, you just want the best tax help for the most reasonable fee, give EG Tax a call. Go to our website at egtax.com. Whether you're here in Western New York, Arizona, or Florida, we will take care of you. Right?
Absolutely.
And go to Ask the Tax Lady, and I'll answer any of your questions. But until next week, I'm Esther Gulias with Tiffany Fabian saying thanks for listening. Have a great week.
Yep.